All right, welcome back, everybody. Time now is 8:13. We are keeping an eye on stocks this morning. This is a look at the Dow Jones. It is currently down 150. Now it's down 142 points. But basically, it has just been an up and down roller coaster, if you will, all morning long. Also, NASDAQ trading up right now. S&P currently down as well. But we are keeping an eye on all of this morning because it's been pretty volatile the past couple of days.
Yeah, so this after, as Brian mentioned, the Dow closed down more than 600 points on Friday. It was down more than 1,200 points yesterday. Yep. So the question is, I mean, we're looking at this on the stock exchange, and we're just wondering how this affects all of us. So we're joined by Brook Anderson, a financial advisor with Kaysen Financial Advisors. Brook, good morning.
Good morning.
Thank you for being with us. So a quick question here. When we're looking at some of these drops the past few days and now sort of this up and down we're seeing today, is this a blip on the radar or is this a sign perhaps of a longer trend?
Yeah, no, that's a great question. I would say it's probably more of the former, probably more of a blip. And what we've seen in the marketplace over the last year is abnormally low volatility with very little shocks to the market, so to speak. And I think what we're seeing now is getting back to sort of what would be more typical, where you typically might see a correction every, well, historically it's been every less than 2 years, and we typically have seen a lot more volatility. Our volatility is at pretty much about a 30-year low in the marketplace. So it's not unexpected. It just feels a little more exciting, I think, because we haven't experienced that in a while. But I think this is all very normal in a healthy marketplace.
Brooke, when Liz and I were talking about this earlier, we talked about, trying to put this in perspective. Back in 2007, a lot of the financial experts were saying, don't panic. I know a lot of the experts that we spoke with right now are saying, don't panic. But really, it comes down to house prices is the question that I'm leading to right now, because it's our most valuable asset. Do you agree with the assessment that we should not be panicking right now, especially a lot of us are considering the home values at this point?
We remember what happened in 08.
We remember, yeah.
Yeah, certainly. No, and I would say that's absolutely the way to think of this. This is normal. These are expected kind of volatility periods within the marketplace, and I would not panic. And in fact, I think that's a mistake that a lot of times novice investors make is they get scared, they sell, and typically we sell at the very wrong time. In fact, I would say that most market timers and all that dramatically underperform the market because they're really not looking at the underlying fundamentals, but they're selling based on emotion. And I would say that's the period that we're in right now.
Yeah, Brooke, that is a good point. It does seem weird that you would sell at this point. But, a lot of us don't really play the stock market, whether if you just don't have enough money to or you're a little freaked out or intimidated by it. So what is the impact maybe a little bit closer to home for some of us when we talk about our credit card rates, maybe interest rates in the future, loan rates? How do we think about this in terms of that?
Yeah, that's a good question. And certainly we are seeing a lift in interest rates, and obviously that's what's kind of spooked the market here in this latest little downturn. But what I would say is historically on a long-term basis, we're still seeing interest rates that are very low. In fact, what we're coming off of is really a 30-year decline in interest rates. If you look back from the early 80s till now, we're just starting to get back to maybe something closer to normal, but we're still well above normal levels. And I think the other thing is we tend to see quick reactions to news, and we tend to see longer-term trends that maybe aren't so dramatic. And I think we'll see, a modest lift in interest rates, but I don't think there's anyone that's anticipating dramatic changes in long-term interest rates as we move forward. I think what you tend to see is a little more choppy weather, and you tend to see some spiking in that, but over a longer time period, I think we'll see this smooth out a little bit. I'm not particularly worried about some kind of massive increase in interest rates by any means.
And Brooke, we only have a few seconds left, but we want to talk really quickly about our retirement accounts and 401ks as well. Is this the time to kind of reevaluate where we are putting our money? We only have a few seconds here.
Yeah, great point. I think this is an opportunity to make sure that you're appropriately allocated. As long as your portfolio is allocated in a well-diversified portfolio at your targeted risk level, you should be fine. And I would not take any dramatic actions because of what we're seeing in the marketplace right now.
And Brooke, we do have one more question here. I mean, we're saying not to panic, right? But in your expertise, what are the signs that you're looking at in terms of the market where you, I guess, not say panic, but maybe give a moment of pause? What should we be looking out for as well?
Sure. Well, what I will tell you is that most of the time bear markets are accompanied by a recession. And we see no signs of a recession anytime soon. If those were to change and you start to see some of the telltale signs of a recession coming on, that would be a climate in which you might want to be more concerned about a prolonged downturn and one that's more severe. So
what are the telltale signs?
I'm sorry, say it again?
What are the telltale signs of a recession?
Yeah, there's a few of them. I would say the leading economic indicators are one great place to look at. Right now, they're all relatively positive. I would say if you're well into an inverted yield curve where you start to see long-term rates lower than short-term rates, that tends to be another sign that a recession is looming. But even in that state, you could be in that state for 6 to 9 months before you actually see a recession. So there's a number of normal signs that we see, and we're not seeing any of those at the moment.
All right, Brook Anderson, financial advisor with Kaizen Financial Advisors. Thanks so much for joining us, kind of giving us some perspective on what's happening on the market this morning. Appreciate it.